Hi, I'm Stephen Keel from Willow Oak Asset Management and Arquitos Capital. Welcome to Willow Oak Asset Management's Value Hour. This is our second quarter review with our affiliated managers. We're excited to have everyone here today. First, I'd like to introduce Keith Smith from Bonhoeffer Capital. Keith, thanks for being here.
Yep.
We have David Waters from Alluvial Fund. And we have Andrew Kuhn and Jeff Gannon from Focus Compounding.
Hello, hello.
So thank you all for being here. We look forward to kind of discussing some of the opportunities and challenges in the second quarter of this year. It's certainly been a unique and instrumental quarter, perhaps one of the most unique quarters in American history, quite frankly, and certainly a lot of interesting things happened during in the financial markets as well. So I want to go around the horn and see how everything went for all of you. If you have any views on the quarter or what you're looking at right now that we're into the third quarter. Jeff, Andrew, if you'd like to start.
Yeah, so it was a very interesting quarter. Let's see, we did well, a lot changed during the quarter. So early on in the first month or so was the biggest change, and then since then we've gotten earnings reports and things that are basically good for about 2 months out of the 3, and we're getting some idea what it's going to look like from here.
Sure. Yeah, it's been interesting to see some of the second quarter earnings now are coming out, especially with the smaller companies. I've been looking at a few of my holdings, looking at things that have just come out the last couple of days to see what the effect has been, and then how they're viewing the third quarter with some of the conference calls as well, and some of the discussions we've had with management of those companies. And it seems to be a little more certainty right now, but it sounds like it's going to be quite a while till we get back to normal. What about you, Dave? How are things going with some of your companies?
Sure. Piggybacking off Jeff, it was an interesting quarter. I think a lot of investors who were complaining about low volatility for the past couple of years will no longer be complaining about low volatility for some time, because we've all had quite enough volatility this year in both directions. It's really intriguing. So yes, we are starting to get, or we have seen most of our Q2 reports from our companies and have dug in to see what's going on. I think a couple really interesting dynamics is, number one, the PPP program that provided pretty significant loans for a lot of companies, with the idea that for a lot of these companies, these loans will be forgiven. They're essentially grants. So, I mean, I've seen in the size of companies I usually look at, PPP loans that amount to 3, 4, 5% of market cap, which is really significant. You find that some companies probably didn't even lose that much income as a result of the pandemic and the forced closures they went through. And so it's really interesting to see which of those will apply for loan forgiveness, and how they'll end up using that cash. Or we know how they're all supposed to use it, but it's anyone's. That's a question for their legal counsel, I guess, as to if they qualify for loan forgiveness or not. Also, there's a huge divergence between the springboard that U.S. equities have, by and large, experienced. Now, some of the smaller companies and the companies that are outside indexes and are a little bit less liquid trading have not quite felt that, but the U.S. has bounced back to a much greater degree, much more quickly than a lot of other markets around the world, even if those economies might be having a better time with COVID. And I find that confusing and interesting and actionable, honestly.
Sure, Keith?
Yeah, I mean, I think it's been, like saying, a very interesting quarter. What sort of bounced back? I mean, initially we had the big shock in Q1, where basically you saw some of the credit markets, the mortgage finance markets freeze up, created some interesting opportunities in terms of some of those names, but then it just rolled through the economy. And what I think's really bounced back now is a lot of these tech names, and since the United States is so tech focused, you look at that's what's caused the rebound in like the S&P 500, and all this gain is primarily due to these large technology companies. And I think what you're seeing now is you're seeing a combination of two things. The firms that have been affected by COVID are down and still continue to be down significantly. And then the ones that are technology, and I think what you're really seeing now is more extrapolation by the market and almost some of these technology wannabes that there's a possibility they could be like one of these big 4 or 5 companies that are out there, but most likely it's not. But the market is pricing them as though they are. So, and this is all being exacerbated by the Fed's policy of just reducing interest rates. And what I find incredible is if you look at investment grade bonds. I was looking at this the other day. So if you look at like A-rated bonds are down to like 1.5% yield. I mean, it's just incredible. It's much lower than it was even at the beginning of the year. So anything investment grade, the rates are basically on the floor. So any particular, I mean, and some interesting names to look along those lines is any sort of interest rate sensitive type of companies, given the Fed is going to keep the rate, the short end of the curve down there for a long period of time. They should get some really nice leverage. As long as their business continues to do well, they can borrow at these incredibly low rates, or at least refinance, and they should get some nice earnings rebound, earnings leverage over the next, as long as the Fed's talking about multiple years here. So for the next few years, these companies should be able to generate a lot of free cash flow. I mean, there's some businesses specifically in areas where there is some concern, but it isn't going down as much. Like, for example, in the network TV business, where you can get stuff now that's selling for, 3.8 times free cash flow. Big companies, established companies. There's some issues with cable cutting, et cetera, like that, but it's actually been ameliorated to a certain extent. But how it's really affecting those companies is the growth isn't quite as high as what was expected. But still, when you're buying things at like under 4 times free cash flow, there's not, a lot of things can go wrong, and you still can be okay.
Yeah, to that point, kind of access to capital, you see this divergence with some of the larger companies and smaller companies. I wonder, Jeff, Andrew, the things that you're looking at, and Dave as well. You talked about the PPP loans already, but relative to some of Keith's observations of this dramatic access to capital that large companies have, what's it like in the universe that you all are looking at?
So, I mean, we look at companies that got PPP loans, and it depends. I think they're able to access it, but the issue is not necessarily understanding how to use it. So you had some that basically took PPP loans when basically they didn't have many customers. And so they just had to figure out other things for people to do that isn't normally their job, to take the loans. And in other cases, we know of some things where they took the loans and think that they won't be able to be forgiven on it because they ended up not being able to reopen some things and stuff like that. And so they really couldn't use all of it for payroll stuff and things like that. We also spoke to several banks that did a lot of these loans for the first time. And their only reason for doing it is basically they hope that it'll help out with some new customers because they think customers of bigger banks, like some banks like Bank of America and stuff, didn't move too fast on some of these things. And so they did that. And, they said, actually the truth is that the cost for us is going to lose money on this because actually the time that we put into it is going to take care of everything that we would make in interest here. But I've been really surprised at how freely banks have been willing to lend to some of these companies. So I think that they're definitely willing to do it. And in some cases, they also feel that they should do it if they feel the customer is a good customer and everything. And I think some of them feel they have a bit of an obligation to do that. And they mostly have plenty of capital in these banks. So they also feel it's a good thing to do for their communities.
Well, I mean, the one thing we've seen like up here in Rochester has been some of the more local banks, I think as you've been observing, Jeff, have really been aggressive and done a great job. I have some friends that are local bankers here. They're working overtime to get all this PPP stuff done. And they're the ones that moved. I mean, the bigger banks, I know a company I'm familiar with had Merrill Lynch, and they couldn't get anything from Merrill Lynch. They wouldn't get, so basically these small banks had an opportunity to really put their good foot forward. And I think they've picked up a lot of clients as a result of that and built a lot of goodwill amongst the small to mid-sized businesses, which a lot of the big banks it may not be economic for them to even have them as customers. So it's a really interesting. And the nice thing about it from a small bank's perspective is a lot of their expenses are reimbursed. So for them, it costs a little bit, but there's more of just the people spending the extra time from that perspective because they do get reimbursed all their fees from the government. So it's an It's an it's interesting how that may affect the banks. Some of the smaller banks have given them a little bit more impetus versus like the longer term trend of them being at a disadvantage because of technology and those types of things.
Do you think there could be, I mean, I know, Dave, you kind of look at some of the smaller, more local banks occasionally. Do you think this is an opportunity for them to take some market share from the Bank of Americas and Chases of the world?
Yeah, I mean, I have the same, I do, yeah, I'm hearing the same thing on the ground with local industrials and consumer companies that in many cases, the large banks just weren't interested in their business because it's just not to the scale they want. And they know there's no real big multi-million dollar opportunity in the future. And so in a lot of cases, small banks were able to pick up some potential new relationships, and some of those won't last, but some of them will be happy with the service, or they like the people and the personal touch, and they'll stick around. Another real tailwind for small banks in Q2 and probably for the rest of the year is mortgage refinancing. Is just everyone's blowing the doors off right now. If you're a small bank and you already had a decent sized mortgage division, and well, you're just writing loan after loan after loan as everyone refinances. And so that's not a long-term trend. I mean, eventually everyone who's going to refinance will refinance, but I'm seeing banks posting annualized return on assets of 5, 6, 7% based on their incredible fee income they're generating this quarter from the mortgage business. And you wonder how much lower mortgage rates can get. I'm buying a house right now, and they are incredible. I thought my rate was great when I got one 5 years ago. Had no idea it could get a lot cheaper. But I mean, hey, maybe I'll end up refinancing in 3 years at 1% or something. That probably means there's big problems in the economy, and I kind of hope that doesn't happen. But it's unprecedented, and a lot of these small banks and the large ones too, but a lot of the small banks are taking full advantage.
I mean, the interesting thing about mortgages, as you mentioned, Dave, is that there's still a wide spread between treasuries and mortgages now. So mortgage rates have not come down, so there could be some compression in those rates, and so this refinancing thing could have a little bit of a longer tailwind, is, you know, given sort of what's going on with the market from that perspective. But I mean, to a certain extent, some banks, when you get down that low, I mean, the question becomes, okay, is it going to compress their margins from that perspective? But I would think, given how competitive stuff is, eventually that may be an interesting tailwind there. But yeah, it's interesting.
Yeah, moving on to kind of another subject, and it's been affected during this quarter and the new pandemic, and I guess our new lifestyle with everything that's happening right now, is how has your research approach changed? Are we still getting the same access to management, doing some of the on the ground scuttlebutt and due diligence? Love to hear how or if anything has changed in your process, and how some of the companies are reacting to maybe communications with shareholders now. Maybe start with Jeff and Andrew.
Yeah, so we had planned to go on several trips during the quarter, and we ended up going on only one, and that was at the end of it. I would say it depended a lot on where we were in the country.
Yeah, for sure. Mm-hmm.
So in urban areas, it was not possible to do much research at all that we would have done. Some things were canceled, stuff like that. However, in rural areas, there was almost no evidence of anything changing for COVID.
Mm-hmm.
Right?
Yeah, no, definitely. And how that relates to management, obviously, at some companies, they have, I don't want to say like an easy no or whatever, but some companies may be reluctant to meeting in person or doing sort of that normal due diligence process because of COVID, which, obviously we understand as well. And Jeff and I were trying to be, responsible about where we went. At one point in our trip, when we went on a 2-week trip, probably about a month or 2 months ago, we were supposed to go somewhere else on the East Coast, and then where was it? Was it New Jersey?
New Jersey, and we would have seen people in New York at the same time, and they changed the COVID restrictions at that time for people out of state. And so we actually went towards Ohio and stuff during that period instead. So we spent a lot of time in rural parts of Pennsylvania and Ohio.
Mm-hmm.
We spent a brief part in more urban areas, but left quickly because we weren't getting stuff done there.
Yeah, and it's always good too because we like to drive on the trips. So I don't want to say we're winging it, but we have like, some ideas of places we'd want to go or companies that we'd want to see, but definitely we had to, I guess, shift gears on both times when we've gone on our trips and, really try to make it as productive as possible. But it's such an important part of the way that we do research, Jeff and I. So it's good that things are starting to reopen again so we could, really start to, I'm planning a trip right now actually at the end of August. But you have to be careful about where you're going and then setting in advance, to meet with the management and that whole process and make sure, they're comfortable with it and do it in a socially distanced manner and, kind of go from there.
Yeah, and for me, there have been so many of these virtual shareholder meetings this year. I think almost everyone has been virtual, of course. I was expecting so much more interaction because, previous years you'd have a company like GE or something, they would have their shareholder meeting in South Dakota, some small town that only a private airplane could come into to kind of limit the activities of retail shareholders coming in. And now everyone had access, right, to these virtual shareholder meetings. And the meetings that I've called into, there have been no questions. I was expecting these to last an hour or two and there to be a lot of interaction and questions. And they do the formal process and then just hop right off. So I don't know if it's a technology issue or what the deal is, or maybe some of these companies, this is a way that they blame technology to not have.
Yeah. Like what? Nobody's on the queue? Okay. Well, thanks a lot for joining.
Well, same thing with conference calls too. Now that a couple of the Q2 conference calls have come about, I've been surprised that some of the questions, there haven't been as many questions as usual. So I don't know what, maybe some of the analysts working from home are having a different situation. Maybe the sell side stuff is acting differently than us. I know we're all working as hard as we ever have to try to do the research we need to do, and we just have to be a little bit more creative to get a hold of the people we want to talk to there. But Dave, Keith, what has your experiences been?
Yeah, I would say that I've had a similar experience with these virtual shareholder meetings. Not a whole lot of interaction. Maybe that's caution on the part of these boards of directors. And when the meeting is not in person, you can't look at that guy. In fact, he looks a little bit crazy. Not sure we want to let him have the microphone. Maybe they're afraid if they just take open questions online, that's what will end up happening. So that's been a little bit disappointing. All the same, though, I've found that company management and CEOs seem like they're getting a bit more comfortable taking video calls and having interaction that way. I've had some really cool calls lately. I was just talking to a couple CEOs in Italy earlier this week, and that was an early morning for me, waking up in time to hit their office hours. But it was great. Probably things that may not have been on their priority list before it became nearly impossible to have a great hours-long face-to-face meeting. So it's been a mixed bag.
I mean, some of the things I've observed is, like you're saying, it's been kind of more difficult in terms of the direct sources, but I think I've really absorbed and gotten a lot more feedback from various online forum things like Twitter and other types of online, sort of. And I think what's happened is, since people, guys like us that are research folks, since there isn't as much face-to-face stuff you can do, there's a lot more discussion of ideas, frameworks, especially with this internet stuff. How's this going to affect our businesses? Disruption. I think there's a much more free-flowing conversation, and I think that the amount of really good comments you can get for concepts and ideas in a place like Twitter has just really surprised me. It continues to. I mean, it reminds me a lot of like what I used to be still I'm on a corner of Berkshire and Fairfax, and one of the big pluses of something like that is you had some people that were thinking about these things and had some really good experience and some real good input that they could put into any question or thesis you've had. And I think I've seen more of that probably in the last 6 months than I've seen before. So I think that's a sort of a different angle in the fact that you're getting feedback from different folks and what they're, in many cases, you don't know who these folks are, right? I mean, it's not, whereas before, you maybe had a group of investing friends you talk with and you can get some input from them, and it's still going on, but to a certain extent, now you can get the network is broadened out to a wider group of people that can, provide some interesting inputs.
Yeah, it's a username now, and I remember for Keith back in the day. For those of you familiar with the corner of Fairfax or Berkshire and Fairfax message board, Keith is a Packer, and he would show up at events, and people would not know his name as Keith. They would yell across the room, "Packer!" And, it was always funny because sometimes Keith, your father, would be there as well, and he'd say, "What? Why are they doing this? Why?" His name's Keith, but that's kind of how it is on Twitter too, with some of the pseudonyms, which is nice though, because some of these people do have influential positions or roles that they have to be anonymous in order to be active online, and it's nice to be able to have access to some of those people. Along those lines, with some of the watch lists, some of the new companies, what are you all looking at now in terms of themes or characteristics of companies, whether it's idea sourcing or some of the ideas on your watch list that are more interesting to you? How are you choosing which ones to kind of do a deeper dive on now and which ones to lay off until later? Dave, if you'd like to start.
I think the one area that I've sort of started to take a look at are more interest rate sensitive type things, and looking at more of maybe some interest rate arbitrage type stuff, because I'm pretty confident that interest rates are going to stay low for a number of reasons, amongst them being low inflation. So if interest rates are going to stay low for a substantial period of time, I think there's some interesting arbitrage that you can really get from some of these things. But
Keep talking. We can't see you, but we hear you.
Yeah, here we go. All right, let me try this again here.
No, just keep talking. You're fine.
Okay. All right. So yeah, sorry about that. But no, for me, it's just I think that's an interesting theme. So some of the stuff I've been looking at have been things that are more along the lines of, maybe like alternative to banks. I mean, there's a number of BDCs which are interesting, that has good underwriting, so you can take advantage of the spread that way. Another way to take advantage of it is if you've got a good company that basically has a good amount of leverage. The leverage can really, in this kind of situation with interest rates being low, as long as you feel comfortable with the business, they're generating a lot of cash flow that can be recurring, and they can finance that at current rates from that perspective. So I mean, I think those are probably two of the themes. I mean, the other things I've been looking at is more stable portions of businesses. So in essence, when you're investing in debt or debt-like securities, you can take a volatile industry, let's say like oil and natural gas, and try and find some more steady state type of situations there. There's one pipeline that I'm looking at that's interesting. If you look at the way the incentives are set up in this pipeline, there's a large incentive for the management to shift the cash flows from the E&P to the pipeline business. Because the pipeline, they own more of the pipeline than they do in the E&P, and the market value is higher. And so I think that's part of the that's part of the story there. So I think those are the things for me that I've been sort of taking a look at from from a lower interest rate perspective.
Sure, Dave, Jeff.
Yeah, I think there's a couple frameworks I'm using to identify companies that might be worth more research or potential investment at this point. I think the first thing you can do is try to find companies that have had their businesses enhanced by the pandemic. They see a higher level of demand for their products and services, a level that will likely remain elevated even if the pandemic subsides in the next year. And if you can find a business like that, but the market hasn't quite caught on to the new reality just yet, well, you might be set up pretty well. The other side of the coin is finding a business where, yes, in the short term, the operations are, well, they're terrible. The revenue is way down, and because of operating leverage, maybe they're running in the red right now. But if you can be fairly confident that whatever they do or offer, people and businesses will still want it in 2 to 3 to 4, 5 years, as much or more as they did before, and they have the balance sheet to see them through this low point of the cycle. If you're willing to take some short-term pain and you really do have a long-term outlook here, then there's some very, very attractive situations on the table. The trick being, you have to find the ones that have the balance sheet or the access to capital to make it through the rough patch.
Yeah, so I'd agree with both of those things actually. Those two make a lot of sense to me. Any business that was like a higher quality business or something but had more leverage is definitely potentially more interesting in the next few years because of its ability to have, you know, really low cost debt. And this is totally different from other recessions we've seen and things like that because credit is very loose at the starting point of it, which is not normally what you see happening. And so I would say that's the biggest difference. And then the other difference, which now in terms of looking at things does remind me of the 1990s, where although people talk about how the S&P is up so much from its lows and all that, it's not so much the median stock in there. It's a small number of stocks that are up a lot. And this time it's a little more connected to things that are not just big, but also people think will do well during this time period too. But some of the things that are in more boring industries, smaller things like that, have not gone up that much, and yet they actually do benefit from like really low interest rates. So this isn't necessarily as serious for them as it has been some other times. So some of those stocks might be very interesting, and that's very different from what normally happens when you have a big drop in the stock market and bad times in the economy, you know.
Yeah, on the subject of interest rates and inflation, I'd love to I'll kick it over to Keith here in a second. I was on a podcast over in the SNN network, and speaking of Twitter, Quote the Raven was on it, and of course he's you know, kind of more of a gold bug. He's worried about significant inflation and money printing. And Keith, I know you have a little bit of a different view. It'd be interesting to hear you elaborate on that.
Yeah. I think the main thing that I see is the difference between, you know, I think where a lot of the gold bugs seem to be thinking is when you print money, that in essence it's going to turn into inflation. But in my view, it's really a two-part process. You can print the money, but if people aren't going to spend it, the velocity is going to go down, which is what's happening here. And what that's really tied to is debt. If you've got a lot of debt, people are going to be paying down debt, and that pay down of the debt basically causes deflation because people are going to have to pay down the debt versus actually spending and driving product prices up. The other aspect of it is really has to do with, I think, just technological, you know, improvements of things, basically driving the cost down. So you have, given where technology is and how long we've sort of had a peaceful sort of economy and the technology improvements, it's just driving stuff. The supply is just exploded. That's part of the reason why a lot of these internet companies are really doing well, because in an age of abundance where you have tons of supply, search becomes a very valuable commodity. Historically, what's been important is if you had control of the supply, then you could get the customers. But when you have tons of supply, search becomes very important, and these search or aggregators become very important in that ecosystem. And I think what's happening is we've developed a very efficient way to distribute and manufacture these products. So inflation is just really, in my mind, going to continue. But you have a built-in, I would say, deflationary aspect of this whole thing. And what's really interesting too about this is when you think about it, what it really does is people are concerned about income inequality, which I think is a big issue. But if you look at it from a deflationary perspective, it may actually ameliorate some of those effects because, so for example, cheap iPhones everyone's gonna get access to cheap iPhones, and it doesn't make any difference what your income is. You're still gonna get access to it, and you're still gonna have it there. So I think there's some real interesting things from that perspective. I think one of the things that I've seen when people have talked about money supply is I haven't heard the second part, which I think that is a key aspect of it, is basically the velocity of money. I mean, the implicit assumption is inflation is going to happen if velocity stays the same, but what we've seen is velocity decline. This happened in the 30s. The same thing happened as it did right now, is the velocity of money just sort of declined like crazy because in essence, you know, people are paying off the debts, and without that. And the other thing too now, like saying, is this technological improvement of things, I think is just made this, the amount that we spend on, you know, stuff that we really need, getting to smaller and smaller piece of the budgets. And when you look at from a business perspective, what that's created is created a huge industry for leisure time. I mean, think about everybody, even the people that don't make a whole lot of money, how much leisure time people have versus like what it was done before. So, I mean, in my mind, it's just those kind of trends are really self-reinforcing. I mean, what you say, well, what can end? What's going to turn this thing around to make inflation? Well, two things can create inflation in my mind: is either shortages or wars, or you know, a war of some type, or a famine of some type. Now, famine, I think, is not going to necessarily happen. I think we pretty much feel that. But so really the only things you got left to create inflation are wars or shortages. And unless you see those two things, I don't think you're going to see much inflation.
Interesting. Any thoughts from the others on the issue?
I mean, I agree with the part about the creation of money is not what causes inflation. So people look at that and not people spending it. But sometimes you can have asset prices rise a lot more than you have consumer prices and things like that. So we may see some inflation in certain things that are tied more to financial conditions. And those asset prices might go up, and that's not inflation. You know, inflation is an increase in consumer prices, but that will, you know, be something that people notice if that does happen, and that's a lot easier to happen when you have a creation of a lot of money.
I think you're absolutely right, Jeff, because I mean, you look at the places where prices have gone up. It's been urban real estate, education, and it's been healthcare. Now, healthcare, the reason why it's gone up is when you think about what healthcare is doing, it's extending people's lives, right? And that actually creates, when you think about it, that can actually be more deflationary, because if you, let's say you extend a person's life by 10 years, they're going to have 10 more years to create new things that in the end is going to be more deflationary in the end. So, and the other one's education, but I think education is going to go through this giant earthquake, which is happening right now. I mean, and I think that's going to be totally changed for a long period of time. You're going to have a lot of restructuring, probably a lot of universities going bankrupt, and it's going to be a different way. So, I mean, I think the three things that have driven inflation, this pandemic has really sort of reduced the I guess the underlying girding of those things. But as you say, Jeff, I mean, I think one of the key things is what you look at what's in shortage. What's in shortage now, and the companies that are going up that are really high are special businesses. They're ones that are in shortage, but there's not that many, and therefore their prices should go up. But how much? That's another question. That's more of a debate. Is it, you know, it should be higher, but how much higher is the question, right?
Yeah, you know, final subject here. I don't know, maybe the interest rates or maybe some of the treasury payments to individuals has caused this, but the whole Robinhood age, where we have a company like Kodak or we have a bankrupt company, you know, have you know, there's discussion about raising capital through a bankrupt company, things of that nature. You know, how long is this going to last? And is this a reproduction of the late 90s where these people are really going to get burned and then be out of the market for some time? Or how do you all feel about that, Dave?
I mean, like anyone else, I know people who never really cared at all about investing or anything, and maybe they go to the casino once in a while, but now they have the Robinhood app on their phone and they ask me for picks. I say absolutely not, won't be doing that. But they yeah, they throw a few $100s at something, and maybe they're happy if it doubles or sad if it doesn't, but it's a phenomenon. And I think part of it is, I mean, unemployment's up, so there's more people just sitting around at home looking for a source of entertainment that they can do at home. And so it's a bit of that. I guess it is reminiscent of the day trading craze of the late 90s, but it's at the same time, it's maybe even more addictive for some people. I mean, back then you still had to start an E-Trade account and pay $7.95. And now it's literally just like a little game on your phone. And I installed Robinhood just for fun, and they do everything they can to make it addictive. There's little fireworks when you open it up, and there's like the little sounds and lights go off when you get your first little stock. And I think I still have like one share of some crummy little energy company they gave me when I started up. That didn't make any sense, but I get why people are into this. I honestly think that, yes, a lot of neophyte investors are going to lose a lot of money, and that'll be unfortunate, but maybe there's an upside that some people will think this is fun, but there's got to be more. And maybe we'll have some people who get seriously into investing and start learning the fundamentals, and that could be a cool thing, to see a new generation get into investing for the first time, and maybe they'll be more financially responsible than some older generations have been. I don't know, but I just think there's, like everything, like every innovation, there's positives and there are negatives, and I haven't seen a lot of people saying. I try to find something in there, and I think that could be it.
Yeah, I think, there's not very much sports, so you're not able to kind of gamble on sports. You're at home if you're unemployed right now, and you get a little bit of money from the government. You have certain Twitter personalities that are fun and exciting, and that addictive nature of the app for sure. I've had the same thing. A few people who have never traded a stock before have asked me as well, and it's a dangerous game. It's a dangerous thing to answer. I'm a little bit afraid of it because you have the casino type approach where you make a little bit of money the first time and then you lose everything you have and a lot more the rest of your trades. I'm afraid some of that's going to be happening, and maybe it'll be in Tesla, or maybe this is an entirely new era and we're the ones that fundamental analysis isn't going to matter in the future for those types of companies. Who knows?
Yeah,
Any final
Too.
What's that?
That's a question on my mind too. So historically, we've always thought, the equity risk premium, it's been debated over, like, why does it exist? Does it really exist? But the consensus has been that yes, it exists, and it's 4 or 5% for a company with a beta of 1. And then you add that to your risk-free rate, and that's about what the stock market should return. Well, I mean, these days, risk-free returns don't, the risk-free rate is 0, likely will be for some time. And so we've basically thrown out the idea that there is a risk-free return. And are we now questioning? Some of the valuations you see make sense if the risk-free rate is 0 and always will be, and the equity risk premium is now, say, 3%. But on the other hand, they don't make any sense if interest rates ever go back to a real rate of 2, 3, 4%, and the equity risk premium is still 4 or 5%. So I guess the big war going on in the mind of investors in the market is which paradigm will prevail over the next 15, 20, 25 years. Are we truly in a new era? Historically, betting on a new era where all the old rules are out the window in investing has been a bad way to go about it. But I just don't know. Technology always marches on. The world's demographics change. Central banks do their thing, and I don't know. So, but that's the question in my mind as well.
Yeah, I mean, I think one of the big things that I see though, which is interesting, which is reminiscent of 99 and 00, is the bifurcation of certain company valuations. You have some that are very, very. I haven't seen that until the recovery of this past quarter. What was happening, I think, going into 2009 is you had the big tech companies, which everybody could agree upon were pretty stable businesses that were going to grow and continue to do well. But I think what I've seen in Q2 going into Q3 now is you've got a lot of these businesses that may be like that, but haven't proven yet, but their valuations show that they're already there. And then you have some businesses that the ones that may be affected, that are affected by COVID, maybe not to a large extent, but then are selling for really cheap valuations. So that was one of the unique characteristics I think I saw in 99 and 00 was there was a bifurcation between different types of companies and what the value and the value that the market would put on them. And I'm starting to see some of that now, maybe not to the same extent, but I think it's moving in that direction.
Well, it's given me a greater appreciation for George Soros's reflexivity for sure, because you've seen this in the market, and it's very obvious in specific stocks and specific companies, and it's kind of interesting. You see, well, what kind of opportunities could we find in that where there's actually attractive valuations as well? But our good friend Liz Hall on Twitter with the idea that the stories can make the stock. Can make the company that lowers their cost of capital. Look, I mean, this is what's happened with Tesla. We can still, also believe that it's extremely overvalued and there's different shenanigans going on there. But the fact is, they're able to issue shares that maybe they otherwise would have been bankrupt, except for their ability to fund themselves through this reflexivity and through this storytelling that Elon Musk has done, and you have to give him credit for that.
Mhm.
Any final thoughts?
Yeah, I mean that what you were just describing there is just like the 1990s. That was the last time that I remember where companies could get to the size that they did because of how many shares they were able to issue and at what prices, things like that. So it is a case where you're actually it will change in some cases. I mean, Andrew and I were talking about some industries where basically all the competitors are venture capital backed and they burn money. But you know, if interest rates stay low and if valuations for them stay high, those companies could stay in the industry for years. And that changes things. And if it was a different market condition, you wouldn't have companies like that burning cash. I mean, if you have to finance yourself from earnings, it's totally different. So it can actually change the industry, like you were saying. It can actually, through reflexivity, do that. Yeah.
All right, well, thank you all for joining us. I'd encourage viewers here to go to willowoakfunds.com. You can learn more about each of the funds and link through to their websites, and feel free to reach out to anyone if you have any questions here. We also are releasing Willow Oak Asset Management second quarter letter. It should go out either today or tomorrow, and you know, hope you'll take a look at that. You can find that on the Willow Oak website as well, and feel free to sign up for regular updates there. Thanks so much for joining us, and Godspeed to Q3.